All right, get ready, because we're about to take a deep dive into IRS Publication 547.
Casualties, disasters, and thefts for the 2023 tax year.
You sent this over, and honestly, it didn't exactly grab my attention at first.
Might not sound like the most exciting topic.
But I have to say, after looking it over, this could be really useful for a lot of folks.
Absolutely. We'll be exploring how to deduct losses.
From all sorts of things, like damaged property.
Stolen property, even destroyed property.
And this is where it's interesting, right? Because the IRS has very specific definitions.
They do, and that's what we'll be unpacking today.
So, like, what exactly counts as a casualty in the eyes of the IRS?
Good question. It's not just any little mishap.
I figured there had to be some specific rules.
Yeah, the IRS is very particular.
So what are we looking for?
The event has to be sudden, unexpected, and unusual.
Those are the key words, right?
Those are the magic words.
Okay, I'm intrigued. Like, what's an example of something that would fit that description?
Well, the publication actually gives a pretty vivid example. Imagine slamming your car door on your hand,
Ouch!
and your diamond ring goes flying off and disappears. That's considered a casualty
Really?
because it was sudden, unexpected, and definitely unusual.
Wow, so a freak accident like that could have tax implications.
Exactly. Even seemingly minor incidents can have financial consequences.
You never know what life's going to throw at you.
That's for sure.
So what about something like, say, termite damage? That can be devastating to a house, but it's usually a gradual thing
You're right. That's a great example of where things get a little fuzzy.
because it doesn't happen all at once.
Right. And that's why termite damage generally isn't deductible as a casualty loss.
Oh, okay, that makes sense. It's not exactly sudden or unexpected.
But here's where it gets interesting.
All right, I love a good plot twist.
What about a sudden infestation of beetles?
Beetles.
Yep. The IRS considers that a casualty.
Hold on, so a swarm of beetles is more tax deductible than termites. Now that's a curveball.
It highlights how important it is to understand those very specific definitions.
Absolutely. So accidents, or in this case, infestations, can be casualties.
Right.
But what about when you just plain lose something? Like if your keys disappear, or even worse, your diamond ring just vanishes.
That brings us to a crucial distinction.
Uh-huh.
Theft versus a misplaced item.
Because I'm guessing you can't just write off anything you can't find.
Not quite. For a loss to be considered theft, there needs to be evidence of criminal intent.
Oh, so there has to be proof that someone actually stole it?
Precisely.
So if my ring just disappears, poof, gone. No deduction.
Unfortunately not.
But if it was lost because of that car door incident we talked about...
That could potentially qualify as a casualty loss.
Okay, so accidents or unexpected events can be casualties, but simply misplacing things doesn't count.
Exactly.
All right, so let's say we figured out that we have a deductible loss.
Okay.
How much can you actually deduct? I'm assuming there are limits.
There are, and that's where the $100 rule and the 10% rule come in.
Okay, break those down for us.
The $100 rule is pretty straightforward.
All right, lay it on me.
You simply subtract $100 from each casualty or theft loss you're claiming.
Okay, that makes sense. Keeps people from nickel and diming the IRS.
Right. Now, the 10% rule is a little more complicated.
Hit me with it.
You have to reduce your total casualty or theft losses for the year.
Bye.
10% of your adjusted gross income.
So let's say my adjusted gross income is $50,000.
Okay.
I have to subtract $5,000 from my total losses.
Exactly. That's how it works.
And this applies to each person, not each item, right?
That is a very important distinction.
So if my spouse and I both lose our wedding rings in, I don't know, a freak boating accident.
You each apply the $100 rule and the 10% rule to your individual losses.
Wow, that's a good thing to know. Definitely a potential trap if you're not careful.
It is.
Now, what about larger scale disasters like hurricanes or wildfires?
That's when things get even more nuanced.
I bet.
Because then you have to understand the difference between a federal casualty loss,
Okay.
a disaster loss,
Got it.
and a qualified disaster loss.
All right, I'm already sensing a headache coming on.
It sounds more complicated than it is.
Well, hopefully.
Think of it this way. A federal casualty loss is basically any personal property loss tied to a federally declared disaster.
Okay, so that's the broadest category.
Exactly.
Then what's a disaster loss?
A disaster loss has to occur in a state that's received a federal disaster declaration.
So it's a step down in terms of scope,
Right.
and then qualified disaster losses. Those are the most specific.
Exactly. These apply to major disasters declared in certain years or tied to specific events like Hurricane Harvey or The California wildfires back in 2017 and 2018.
So all qualified disaster losses are also disaster losses, which are also federal casualty losses, but not the other way around.
That's a great way to put it. You're getting it.
And why does all this matter? Is there a reason to care about these different types of losses?
There is. And it's all about tax benefits.
Ah, now you're speaking my language.
For those qualified disaster losses.
The really specific ones.
Exactly. The $100 rule becomes a $500 rule.
So you only subtract $500 instead of $100 from each loss.
You got it.
And what about the 10% rule? Does that still apply?
Even better.
Tell me more.
The 10% rule doesn't apply at all for qualified disaster losses.
Wow, so getting that qualified designation can make a huge difference.
It can be significant.
It's a lot to keep track of, though.
It is, which is why it's good to have this information.
Is there anything else unique about disaster area losses? Anything we should be aware of?
Actually, yes.
Lay it on us.
Taxpayers can actually choose to deduct the loss on their previous year's tax return.
Wait, so instead of claiming it for the year the disaster happened,
You can apply it to the year before.
why would someone choose to do that?
It could lead to a lower tax liability for that previous year.
And potentially a bigger refund.
Exactly.
So if you had a rough year financially, you might be able to use a disaster loss to offset some of your income from the previous year.
That's right. It's a strategic move to consider.
That's helpful to know. Okay, so we've covered what qualifies as a casualty, the limits on deducting those losses,
Right.
and the special rules for disaster areas.
Mm-hmm.
Now, what happens when you receive insurance money or some other kind of reimbursement after a loss?
That's when you might actually have a taxable gain, even when you've experienced a loss.
Wait, a gain. But we've been talking about losses this whole time.
I know, it seems counterintuitive.
It does.
But here's the thing. If the insurance or other reimbursements exceed the property's adjusted basis, then you could end up with a gain.
Adjusted basis, quick reminder, what is that again?
Basically, it's the original cost of the property, adjusted for any improvements or depreciation.
Right. It's different from fair market value.
Exactly.
Okay, so if the insurance company gives me more than my adjusted basis, I have to pay taxes on the difference, even though I lost something.
That's the general rule.
Ouch.
But there is a workaround.
I'm always up for a good workaround, especially when it comes to taxes. What is it?
You can postpone reporting that gain by reinvesting the money into similar property within a certain time frame.
So if my house burns down and the insurance payout is more than my adjusted basis, I can avoid paying taxes if I use that money to rebuild.
Precisely.
That makes sense. It encourages people to get back on their feet after a loss.
Exactly.
That's helpful. Any other key details about gains and reimbursements?
One more thing. The IRS actually provides a helpful table in Revenue Procedure 2018-08.
What's that for?
It helps you calculate the value of your belongings for qualified disaster losses.
So it takes the guesswork out of figuring out what your stuff was worth?
Exactly.
That's great. This is all fantastic information, but let's be real. Most people don't keep super detailed records of everything they own.
That's true. But it's so important.
Especially when it comes to things like clothes or furniture.
Especially then.
The IRS is pretty strict about documentation, aren't they?
They are. You need to be able to back up those losses.
So what kind of records are essential?
You need proof that you own the property.
Okay.
Documentation of what happened and when. And you need to show that the loss was a direct result of that event.
Makes sense. What else?
You also need to show whether you filed an insurance claim.
And how much you're expecting to get back.
Exactly. Thorough record keeping is crucial.
Okay, so what kinds of things should people be saving?
Receipts for any purchases.
Of the damaged or stolen stuff?
Exactly. And receipts for any repairs or improvements.
Got it. Anything else?
Photographs or videos can be super helpful.
To show the condition of your belongings?
Yes. Ideally, take pictures before and after a casualty or theft.
What about insurance documents?
Those are crucial. Keep copies of your policies, any letters or emails from your insurance company.
And settlement documents and checks, I'm guessing?
Absolutely.
Yeah.
You want a clear paper trail.
So you can prove how much the property was worth, how much insurance you had, and what you actually received.
Precisely.
Yeah.
It's like building a case file for your loss.
That's a great way to put it. And where should people keep all this documentation?
Somewhere safe.
Yeah.
Preferably not in the same place as the property itself.
Yeah, a fireproof safe or cloud storage would be smart.
Exactly. Be prepared for anything.
Good advice. What if all your records are lost in the disaster itself? Like, what happens then?
Don't worry, the IRS provides guidance on how to reconstruct lost records.
Oh, shoo, that's a relief.
You can find info on their website and in Publication 3067.
Good to know. Okay, before we wrap up this part of our deep dive,
Okay.
there's one more topic in this publication that's a little different from what we've been talking about.
Losses on deposits.
That's the one. This seems pretty far removed from damaged cars and stolen jewelry.
It does, but it's still important.
What are we talking about here?
What happens when your financial institution goes belly up?
Like bank failures.
Exactly. If your bank or credit union becomes insolvent,
Or bankrupt.
right, you could lose money.
The money that was in your accounts.
Unfortunately, yes.
Yikes, that's scary.
It is. But the IRS gives you some options for dealing with these losses.
Oh,
You can claim it as a casualty loss.
like we've been talking about.
Exactly. Or you could treat it as a non-business bad debt.
So two different ways to handle the same situation.
Essentially, yes.
But how you choose to treat it affects how you report it on your taxes.
That's right. And we'll get into that more in the next part of our deep dive.
Great. We've already covered so much ground,
We have.
from those unexpected beetle infestations
Right.
to the ins and outs of disaster area losses and even bank failures.
It's a lot to take in.
It is. Who knew there was so much to learn about casualties, disasters, and thefts?
And we're just getting started. There's even more to uncover in the next part of our deep dive. You won't want to miss it. Welcome back. Ready for more?
Absolutely. Hit me with some of those savvy tax tactics you mentioned.
All right, let's jump into a real-life situation.
Perfect.
Imagine you own a beautiful antique grandfather clock.
Okay.
It's been in your family for generations, worth, let's say, $10,000.
A real family heirloom. Now tragedy strikes. A fire rips through your house, completely ruining the clock. Oh no, that's terrible, both sentimentally and financially.
It is, but thankfully you had it insured.
Smart move.
The insurance company assesses the damage and gives you $8,000 for the loss.
Okay.
To figure out if you have a deductible loss, we need to look at the clock's adjusted basis.
Right.
Let's say for this example, the adjusted basis is $5,000.
So the insurance payout is more than the adjusted basis.
It is.
Does that mean a taxable gain, even though the clock was destroyed?
You got it. You'd have a gain of $3,000.
That seems so strange, having to pay taxes on something you lost in a fire.
It can feel that way, but that's why understanding postponement of gain is so important.
Right. Remind me how that works again.
Basically, you can postpone reporting that gain if you reinvest the money into similar property.
So in this case, would buying a new grandfather clock count as similar property?
It definitely could. The IRS is pretty flexible with the definition of similar or related in service or use.
Okay.
The replacement just needs to serve a similar function.
So I could buy a different antique clock, or even a modern one.
Exactly, as long as its primary use is still telling time.
So you don't need to find an exact replica, just something that serves the same purpose.
Exactly.
So by reinvesting that $8,000 into a new clock, I could avoid paying taxes on that $3,000 gain.
Precisely. You replace what you lost without the extra tax burden.
That's a big win. What other scenarios might people find helpful?
Let's switch gears and talk about car accidents.
Oh, yeah, everyone's had a fender bender at some point.
Right, so imagine you're driving down the road and bam, someone hits you.
Been there.
Your car's totaled.
Thankfully, you're okay.
Yes, that's the most important thing.
Definitely.
But now you have to deal with the aftermath.
Not fun.
So let's say the fair market value of your car was $15,000 before the accident,
Okay.
but its adjusted basis is $10,000.
Got it.
The insurance company says it's a total loss and gives you a check for $12,000.
Again, the insurance payout is higher than the adjusted basis, so
Right.
potential taxable gain again.
Exactly. You'd have a $2,000 gain in this case.
Okay, but like the grandfather clock, I could probably postpone that, right?
You could by buying a new car.
Okay, and how long do I have?
The IRS gives you 2 full years from the end of the tax year when the accident happened.
So if the accident was in 2023,
You have until the end of 2025.
to buy a new car and avoid paying taxes on that $2,000 gain.
Exactly. It gives you some time to find the right car and figure out your finances.
That's great. Takes some of the stress out of a difficult situation.
It does.
I'm really starting to see how understanding these rules can make a difference.
That's the goal.
Anything else you'd highlight when it comes to this publication?
Good record keeping is so important.
Right. We touched on that earlier.
I can't stress it enough. Those records are your proof.
Without them, even legitimate losses could be disallowed.
Absolutely.
So, any tips for staying organized?
Keep all your receipts for purchases, repairs, improvements.
For all my property.
Ideally, yes.
Okay, what else?
Take photos and videos of your stuff too, especially before and after anything happens.
To document the condition.
Exactly. And make sure you keep those insurance documents.
Like the policies and any correspondence.
Yes. And settlement documents, checks, anything official.
So you have proof of what happened?
Exactly. Keep it all together in a safe place.
Not with the property itself, right?
Right. Fireproof safe, cloud storage, something secure.
Be prepared.
Always a good idea.
This has been incredibly helpful. We've covered so much.
We have. From those grandfather clocks to car accidents.
And, of course, all that record keeping.
It's all connected.
I feel like we're really starting to get a grasp on this publication.
I'm glad to hear that. We're not done yet.
There's more.
In the final part, we'll talk about even more unique situations.
Like what?
Like Ponzi schemes.
Oh, wow.
And even corrosive drywall.
All right, now you've got my attention. Can't wait to hear what the IRS has to say about those.
It's going to be fascinating. Stay tuned.
Okay, we're back. Ready to wrap up our exploration of IRS Publication 547.
Casualties, disasters, and thefts.
I'm really curious about those unique situations you mentioned.
Like Ponzi schemes.
Yeah, those are pretty scary. This can really mess up people's finances.
Absolutely. And the publication actually gives some guidance for taxpayers who find themselves victims of these schemes.
So if you lose money in one of these scams, can you claim it as a theft loss on your taxes?
Well, it's not always that straightforward.
I figured there had to be a catch.
The IRS has specific rulings and procedures for Ponzi scheme losses, and they can be pretty complex.
Sounds like it could get complicated quickly.
It can. This is definitely a situation where talking to a tax professional is a good idea.
Yeah, get an expert opinion.
Exactly. They can help you navigate those rulings and make sure you're taking the right deductions.
Solid advice. So what other unusual situations does the IRS cover?
Let's talk about something that was a big deal a few years back. Corrosive drywall.
Oh, yeah, I remember that. It caused a lot of problems for homeowners.
It did. From bad smells to health issues and damage to appliances, it was a nightmare.
It was. So how does the IRS handle those losses?
Well, they recognized it as a unique situation and put a specific procedure in place.
Okay, what does that look like?
Since those losses weren't usually tied to federally declared disasters,
Okay.
they're only deductible up to the amount that doesn't exceed any personal casualty gains you might have had that same year.
So if you had a gain from a different casualty or theft,
Right.
you could use the corrosive drywall losses to offset it.
Exactly. It's like a balancing act.
Interesting. And the procedure lets you treat those repair costs as a casualty loss in the year you paid them.
That's right, even if the damage happened gradually over time.
So it gives homeowners some relief in a really tough spot.
That's the idea.
Wow, this has been a fascinating deep dive. We've gone from basic definitions to complex deductions, gains, and now these unique situations.
It's been quite a journey.
Who knew there was so much to learn about these often overlooked parts of the tax code?
You never know where you'll find valuable information.
So for our listeners out there, what's the key takeaway here?
Even though nobody wants to deal with casualties, thefts, or financial disasters,
Right.
understanding these tax rules can save you money and headaches down the line.
It's all about being prepared.
Exactly. And remember, this publication is just the tip of the iceberg.
There's even more to learn.
Oh, absolutely. We didn't even get to things like losses from timber theft or condemnations.
Wow, it sounds like there's a whole world of tax info out there.
There is. And the IRS has tons of resources on their website, publications, tools, even social media.
They're on social media.
They are. It's worth checking out.
You learn something new every day. Well, this has been an eye-opening deep dive, I have to say.
I'm glad you found it helpful.
I think our listeners will too. It's always good to be informed, right?
Absolutely. The more you know, the better equipped you are to handle whatever life throws your way.
Well said. Until next time, stay curious and stay informed, everyone.